Good morning, hunters. Welcome to the Daily Hunt for Multibaggers on this Thursday, January 8th, 2026. We've got a packed show for you today.
Absolutely, Ethan. Our AI-powered analysis from yesterday, January 7th, definitely gave us a lot to chew on. We saw a really significant number of posts across a wide range of companies, which means there's a lot of chatter out there.
That's right. The market sentiment seems pretty mixed right now. A real blend of cautious optimism and some deep skepticism. We've got some interesting situations with big tech and some emerging plays.
You know, it's those mixed signals that make our hunt so critical. Today, we're dissecting the data to really understand where the momentum is and, more importantly, where the risks are hiding.
All right, let's jump right in with Netflix Inc., NFLX. Yesterday's analysis shows the sentiment as slightly bearish with a stay away suggestion. This is actually a downgrade from our buy rating just a day before on January 7th.
And for good reason, Ethan. While the discussion had one user declaring long live the king, many other comments were quick to point out that the king in that context often falls to his death. Our KPIs are quite telling. A PE ratio of almost 38, suggesting high growth expectations, but the stock is closer to its 52-week low. Plus, there are some serious user concerns about content quality and if their business model is becoming a holdover from a simpler time. That kind of sentiment is hard to ignore, especially when the current price is struggling.
But you know, Brooke, the news mentions a potential strategic alliance with Warner Bros. Discovery. Some reports even suggest WBD might favor a Netflix deal. That's a huge potential catalyst. And with earnings coming up on January 20th, a strong report could certainly turn that sentiment around and justify some of those growth expectations.
It could, Ethan, but the high PE is pricing in a lot of that potential already. Negative content quality comments could easily impact subscriber retention. Until we see that WBD deal solidify or those earnings prove a significant shift, the current metrics, high PE, proximity to its 52-week low, and revenue growth of 17%, which is decent but might not justify the valuation if content quality concerns linger, mean we should be very cautious.
Fair points. So for Netflix NFLX, our AI-generated insight for today is stay away. Next up, Warner Bros. Discovery, WBD. Our analysis has a neutral sentiment and a stay away suggestion. This continues our trend for WBD, as we frequently classified it as either stay away or speculative gamble in recent months.
And the KPIs scream caution here. We're looking at an astronomical PE ratio of over 150. That's incredibly high for current earnings. On top of that, negative revenue growth at -6% and a very high debt-to-equity ratio of nearly 90. The low net profit margin also worries me. While the stock has seen a significant run-up recently, the underlying fundamentals are not supporting this valuation.
However, Brooke, WBD is right in the middle of a strategic battle, as some social media users described it. They're actively rejecting bids from Paramount and are potentially exploring a Netflix deal. These are huge corporate maneuvers that could completely reshape the company. If they execute a successful strategy, these numbers could drastically improve. The market might be pricing in these future expectations.
Could is the operative word, Ethan. We're talking about unproven future potential. While the market might be anticipating a transformation, right now the high PE, negative revenue growth, and massive debt load are clear red flags. Relying solely on future strategic initiatives without seeing concrete improvements in financial performance is highly speculative. It's too much risk, in my opinion, for what we know today. Understood. So for Warner Bros. Discovery, WBD, our verdict is stay away.
All right, let's talk about Meta Platforms, META. Interestingly, despite a strongly bearish overall sentiment from social media discussions, our AI-generated insight for today is a buy. This is consistent with our buy rating yesterday, January 7th, and many times before.
I know, the user comments were pretty brutal. Fuck you Meta being a common theme, with complaints about selling off, too many dads, and skepticism about the metaverse and AI strategy. From a risk management perspective, that level of negative community sentiment, even if not fully aligned with fundamentals, does create a volatile environment. The stock is also significantly below its 52-week high, which for some is a sign of underperformance.
But here's where the data tells a different story, Brooke. Insider buying has been massive. Over 1.9 million shares purchased, a 146% increase in holdings by insiders over the last 6 months. That shows immense confidence from those closest to the company. Plus, Meta is still a cash cow, as some users acknowledged, with robust revenue growth of over 26% and an incredibly healthy net profit margin of nearly 31%. These are strong fundamentals that suggest the company is thriving despite the public's current grievances. Their strategic acquisitions and ongoing AR/VR innovation are also setting them up for future growth.
The insider buying is compelling, I'll give you that. And yes, the revenue growth and profit margins are impressive. It just goes to show how disconnected sentiment can be from actual financial performance sometimes. The critical point is whether those strong financials can overcome the perceived issues with content quality and expensive metaverse bets in the long run. If that revenue growth can sustain itself and the new ventures gain traction, then the current price could indeed be an attractive entry point for growth.
Exactly. So for Meta Platforms, META, our insight today is a clear buy. Next, we're diving into NVIDIA Corporation, NVDA. The overall sentiment from user discussions is bearish, leading to a stay-away suggestion from our AI-generated insights. This is a shift from our buy rating on January 7th. The social media discussion around NVDA, especially the post describing a 125K margin play, really highlights the immense risk some investors are taking. Comments like "what could possibly go wrong" are dripping with sarcasm, reflecting the perception of extreme overvaluation. The PE ratio is over 46, suggesting that a lot of future growth is already priced in. The stock is near its 52-week high, meaning less immediate upside, and its high debt-to-equity ratio of over 9 amplifies the risk for anyone using margin. I hear you on the short-term speculative risk, Brooke, but let's not forget the bigger picture for NVIDIA. The company's long-term outlook is overwhelmingly positive. We're seeing strategic shifts by the CEO, new AI technologies for autonomous vehicles, and the upcoming Vera Rubin for CES 2026. Analysts overwhelmingly have buy ratings, and the company still boasts incredible revenue growth of over 62% and an incredibly healthy net profit margin of over 53%. While short-term speculation on margin is indeed risky, the fundamental long-term growth story is incredibly compelling.
It is a compelling long-term story, Ethan, but our current analysis, driven by today's specific chatter and the associated high-leverage context, emphasizes caution. For immediate high-leveraged plays like the one discussed, the risks associated with such a high valuation and market position are substantial. Yes, the company's innovation is undeniable, and that will improve future KPIs. But for today's market commentary, we have to lean on current signals.
Point taken. For NVIDIA and VDA, for today's analysis, our insight is stay away from speculative high-leverage plays. Let's turn our attention to Lockheed Martin Corporation, LMT. This is a new one for our podcast, so no previous rating. Our analysis indicates a neutral to slightly bullish sentiment, but with a stay-away suggestion for now.
You know, this one is a bit of a head-scratcher. The sentiment from the users was very much about political volatility. A high PE ratio of over 29 and a P to B ratio of nearly 18 suggest the stock is already richly valued. The dividend yield is attractive, but there were explicit political threats to restrict defense contractors from issuing dividends or buybacks. But the biggest red flag for me is the incredibly high debt-to-equity ratio of almost 359. That's a massive amount of leverage. Plus, we've seen some insider selling recently, which isn't a great sign.
While those are certainly valid concerns, Brooke, the positive news is hard to ignore. We saw a proposed increase in the defense budget from $1 trillion to $1.5 trillion for 2027. That's a huge tailwind for defense contractors like Lockheed Martin. They also reported record deliveries of 191 F-35 jets in 2025, showing strong operational performance. These developments have the potential to significantly boost future revenue and earnings, eventually making that PE more justifiable. The stock also quickly recovered from its initial political dip, showing resilience.
The potential for increased military spending is a strong future driver, but it's potential for 2027. Right now, the market seems to have already priced in a good chunk of that optimism given the high PE. That high debt load, coupled with the political uncertainty around shareholder returns, just makes it too risky for a buy classification right now. We need more clarity and perhaps a more attractive entry point.
All right, for Lockheed Martin, LMT, our AI-generated insight today is stay away for now. All right, finally, we've got Applied Digital Corporation, APLD. The sentiment here is strongly bullish, and our AI-generated insight is a buy. This is an upgrade from our cautious buy rating on December 10th.
Ethan, APLD is an absolute rocket ship, but it's important to note the extreme volatility. Its beta is nearly 7, meaning it moves almost 7 times more than the broader market. Historically, it's been unprofitable with negative net profit margins and EPS. While the Q2 2026 results were impressive, showing a massive 200% revenue jump, that kind of volatility demands a high risk tolerance.
The high debt-to-equity ratio of 63 is also a point of concern, even with a strong cash position.
But Brooke, the growth here is truly exceptional and accelerating. A 250% year-over-year revenue increase is a game changer, driven by huge demand in high-performance computing and data centers. They also secured a massive 200-megawatt lease for Polaris Forge 2, potentially worth $5 billion, which cements long-term revenue streams. And critically, they significantly reduced their net loss, showing a clear path to profitability. Analyst coverage is initiating buy ratings with aggressive price targets, and we've seen insider buying too. This isn't just hype, it's tangible growth in a booming sector. The historical unprofitability is being reversed.
You're right, the improving profitability trend is key, and that kind of revenue growth is phenomenal. For investors comfortable with extreme volatility and a higher risk profile, the fundamental shift in financials and strategic positioning in the AI data center market does make it attractive. It has certainly earned its upgrade. I agree. For Applied Digital, APLD, our AI-generated insight today is a confident buy. All right, let's recap our daily hunt. Investigate as buy. Meta Platforms, META. Applied Digital, APLD. Investigate as cautious buy. None. Investigate as speculative gamble. Lockheed Martin, LMT. And that wraps up another episode of the Daily Hunt for Multibaggers.
Just a quick reminder, this podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
Thanks for tuning in, everyone. We'll catch you next time on The Daily Hunt.
Happy hunting!